Welcome everyone to Jim Dalton's presentation, How to Observe the Opening, Part 1, or How to Observe a Market Starting with the Opening, Part 1. The next webinar, Part 2 of this series, will be next Thursday, March 9th at the same time, 4:30 Eastern. Great to see you all. Thank you for coming out. Hope you had a great day trading and a great day wherever you're at. This webinar is being recorded, as all our public webinars are. So if you need to come back and review, it's under jdaltontrading.com, webinars, recorded webinars. Okay, so thanks to everyone for being here. Great to have you. And if you have any questions, please type them in. If you are not aware, the slides are at this post at the website. So go to upcoming webinars, but I'm going to move them over to the handout section as well here. But some people have an issue with the GoToWebinar interface, so you can always get them at jdaltontrading.com. under webinars, upcoming webinars. So with that, I'll hand it over to Jim. Hi, Jim.
Good morning. Good afternoon. I'm sorry. We're talking about the morning presentation. Julia, are you set up? What I'd like to do, if possible, I'd like to play Monday morning. You can play at a little faster speed, just for people to see what the market looks like on the opening. Then I want to go back and use the slides and narrate it. Are we set to do that?
Yes, I think I'm the organizer here. Yes, let me just put it back to my screen. Okay, everyone can see my screen, I assume. Okay, thank you. Jim, you're cool, you can see my screen?
Yes, I can.
Okay. I did the first part of this recording at regular speed, only for about 15-20 seconds.
Okay.
So just give it a second here. Then I moved it up to 30.
Okay. This is Monday morning.
Yep.
I just want you to feel what's going on in this market. Then we're going to go back and narrate it. Now she's speeded it up, so we just get a feeling. Remember what we've said early on. You know, when you open within the previous day's range, you want to be very careful. There's usually a lot of chop. Be thinking about why to be cautious on the break. We'll answer it when we get to the slides, but for those of you that know how to observe a market, you should already be attuned to what I'm referring to. You'll see it in a couple minutes. How many of you were trading Monday morning and got chopped up during this market? we'll just go just a little bit more, and then we'll go to the slides and kind of walk through this market. So I want you to be thinking, if you traded Monday morning, if you traded, how did you do? Did you get chopped up? Did you do it right? What were the key things you were looking at? So now we're in the second hour of trade, which, like we say, we've speeded this up. Hold on just a second. And to clear my throat. So we're in the, it's an hour, going on an hour and a half in this market. You can see we have a lot of volatility, a lot of chop. Notice that last low was exactly to half back. Who's trading when it goes exactly to half back? Okay, let's stop there. And I'm going to go to the slides.
Okay, let me hand it back to you. And everyone,
Okay.
the slides are there on the handout section. Or like I said, you can go to jdaltontrading.com upcoming webinars and you'll find this post not far down. Okay, we can see your screen, sir. Is it me or Jim? I can't hear you. Can anyone hear Jim? Sorry for the technical glitch here.
No, that's me.
Okay,
Okay.
pardon me.
I'm sorry, my voice is very froggy. Hold on, I'm going to try and clear it one more time.
No problem.
I'm sorry, I've got a little something in my throat that makes it froggy. Okay, as a trader, one of the things that you need to be able to do is get your emotions under control and be able to really know what is going on in a market. The more emotion you have, if so, for example, some people come in, and the worst thing that happens, they're so anxious for the day to start. They're just so afraid they're going to miss the best trade of the day. Does it go up? Is it going down? Which way do you think I should go here? When you get into that frame of mind, you have very little chance of being successful. You need to be able to have a very calm look to the market when it first opens. Granted, sometimes you need to operate fairly quickly. Other times, you're better off to wait. So let's talk about coming into Monday. Okay, so what do I know coming into Monday? All trends are up. New all-time high was made in the overnight market. We know it's very unlikely from everything we've done in the past that is lasting. Sometimes it may last for a few days, but it is unlikely that will last for any meaningful length of time. In the current example, we know that overnight inventory is moderately long. When overnight inventory is long, just go through the rules for a second. Overnight inventory is long and the market goes straight up. It's a pretty strong market. That's what we had today. Overnight inventory is long. The odds are pretty good that we're going to get either a partial or a full correction of overnight inventory. So if it's long, a correction would be a counter auction, would be selling. That can take two forms. Number one, it can be pretty aggressive on the sell side, and the market looks like it's never going to give up, or it can go down moderately, and it could restrict that long inventory, can restrict the market from going higher, and it may be just a slight pressure on the downside. Okay, but coming into Monday, overnight inventory was moderately long. We had a spike from Friday, and you'll see that spike in a minute. It's a late spike, it's a late price probe to the upside. We have the spike rules. The base of that spike is support. Staying and finding acceptance within the spike is very positive for the market, because it tells you that those late prices are being accepted. If it opens below the base of the spike, it's negative because it shows you that the spike was rejected. Finding acceptance above the spike tells you the market did not go high enough to cut off the buying that came in late on Friday. Also, we had a very prominent point of control from Friday, and we know the more prominent a point of control, the greater the odds that it may go back and retest that. Okay, doesn't always happen. It is just one of the factors that you use in order to get some idea of the odds of continuing upwards. So as we get near the opening, we're watching overnight trade, and we see the market expected to open within Friday's range and within the upper spike. When you open within range of any kind, the odds are, at least early, that you're going to get chop and you're going to get rotation, that the market is within balance. It may be at the upper end of balance, so it may have a greater odds of going higher or breaking really hard, but you're in balance. The more you open in balance, the greater the odds that you're going to get chop early on. The more you open in balance, the better off you are to wait and patiently place your trade as you see the market develop. Okay? We've talked about cognitive dissonance quite often. And we've said, I've got a new definition for it. And I got this definition from reading a book called A Man for All Markets. The book was written by, it's really kind of the biography of Ed Thorpe, who initially wrote How to Beat the Dealer, and then he followed that up with How to Beat the Market. Nelson Taleb did the introduction to the book, but in there, I like the definition. Examining biases coming today. We have an advanced definition of cognitive dissonance, where you want to believe something enough that you simply reject any information to the contrary. I don't know how many people I have talked to recently that just can't get it out of their mind that the market's too high. And that may be fine, and Monday that may have been fine for a long-term investor that didn't want to hold long-term positions. That is immaterial for a day time frame trader. That is a kind of bias. Carrying that bias is a kind of thing that is destructive to a day time frame trader, because it has nothing to do with the time frame you are trading. Okay, you've examined those biases. It's Monday. Let's go take a look at the opening. Okay, there's a lot on this slide. Let me walk through it. First, you're seeing overnight inventory. This was the settle on Friday. So overnight inventory is moderately long. Maybe it's a little heavier than moderately long, meaning that the trade took place above Friday's settle. Normally overnight inventory is weaker buyers. Also, we will look at number 7 down here. This is the contract volume trading in the 30-minute period. To the left, which says number 8, that is the volume for, at that price, total volume for that price throughout the day. You will see that we have an arrow pointing to Friday's high. You'll see over on the left, you see the high from February 23rd. We see the spike. This is the bottom of the spike. Okay, the yellow circle here is the opening. Number 6.
Green.
Pardon me?
The green circle. Just so there's
the green circle.
Yep.
The green circle is the opening. The yellow line is the last trade. Okay, so as we look at the first slide, what we're looking at is the first 30-minute, this is taking place during the first 30-minute period. This is the opening, and this is the low for the first 30-minute period. This is the last trade. All right, now, before I go to the next slide, I had some people answer to you, what is the most obvious or salient feature that you might comment on during this first 30-minute period? Let's see if you get some answers. I'm going to bet you do. What kind of answers are you getting?
Acceptance in spike. The base of the spike held, not closing the spike. It took out the overnight low. Trade came to base of spike and reversed, looked below and back in range. He's referring to the overnight. No change from Friday. The spike, it stays within the spike, overnight corrected. Didn't get to Friday value area. Look below and fail. A lot of people seeing that trade on the overnight. Narrow range, no selling. Stayed away from the prominent point of control. I assume he means from Friday.
Okay.
Open in spike and value starting to form higher.
Okay. Okay. Let me take over. All good answers. Hold on. I got to go to mute for a second and sneeze. Hold on. I'm sorry. I'm back. Okay. I think the single most important thing that caught my attention as I was watching this market, and I'm going to go to the next slide, was that the early morning high was at unchanged from Friday. So we would call that a weak high. The definition of a weak high, it was at some exact reference. So it's a mechanical high and an exact reference. It is a good high because you have single print selling tails. But it is a weak high because it exactly matches a mechanical reference. When I see that happen, when I saw that happen, I immediately looked and I said that I believe that the odds are fairly low that that is going to be the high for the day. So you're talking about looking at a market. It's one of the things that I'm looking at. Now, you're right. We opened within the spike. We should expect chop. We did not get to the base of the spike. So we look here. Here's the last as of 9:43 a.m. We have a questionable high. We have had some sell-off relative to long overnight inventory, which is not unexpected. Okay? Now you'll see, and incidentally, just so you know, I did not cherry pick these slides. I took these slides in the order in which you're seeing them, and before anything else happened. I had just decided that Monday was going to be the day that I used for the webinar today, because that was the opening. And so you see the first slide I made the notation before I had any idea what was going to happen. But in my mind, I already thought that the odds were low that the high was going to be any good. Now, notice the high right now is now, the first one was one tick below unchanged, and now, what did I do? Go to another slide, hold on. Now this next high is a poor high because there is no excess on the high. In other words, there are no single prints. And it's also come back to exactly just about a tick above half back from overnight. That is also when you have no real long-term money in the market. It's another reference. It's a mechanical reference. Traders know that reference. Half back during the daytime frame, half back during the night are always relevant references for daytime frame traders. Now what you'll see is the last trade as of 10:28 a.m. Eastern Time when I took the next slot. So we just got done commenting that the market went mechanically to half back overnight. It was a poor high. It was a poor high because there was no excess, and just just a tick or so above or right around the high from the 23rd. So at this point in time, as we've looked at this, there's been good information to how you want to trade this market. Okay, so now we went down and we came back up, and let's take another look at what happens. Remember, we opened within range, still very choppy. Notice the market made a pullback in the B period. The pullback low was at Friday's high. 37 contracts traded at Friday's high on the pullback in C period. That is a momentum, daytime frame trader, momentum buying level. That's mechanically what the momentum traders do. So it went back there exactly to that level. That is what I'm talking about. How do you observe a market? How do you know what's going on? How do you know how much confidence is in a market? I'm trying to lay out the things that you need to be aware of and need to look at. This never comes easily, but if you're going to survive as a daytime frame trader, what I'm trying to give you are the things that you need to be aware of. Now, what happens when if this is new to you, is a lot of information at first. It's just mind-boggling at first. How do I keep, you got your emotions involved, you're watching all this thing, and you're saying, how in the world do I keep track of all this? The example I like to use is when you first time you've ever backed a car out of a garage. You know, you start the car, you look over your shoulder, you very carefully start to back up, you're looking in the mirrors, you're double checking everything. After you've done this for a period of time, it becomes fairly automatic. It's what you say, what we say, you have chunked that information. You can learn to observe what goes on in a market the same way you can learn to back up a car. You have to know what to look for, and the more you do it, the more it becomes a routine. You do it over and over again. So that's what I'm doing. These are the things I'm looking at. So early on, we opened within the spike. So we opened within the previous day's range. We knew overnight inventory was moderately long. Not unexpected that we go lower. The first morning high was a tick, either at or a tick below, unchanged from Friday. From experience, the odds of that remaining are fairly low. The market did then go back up. The first pullback after we finally extended in C period, we pulled back to a mechanical level, which was Friday's high. That is a momentum buying level. Let me see. The market pulls back again in D period, exactly the same place it went in C period. That's the second momentum buy level. See how mechanically a market can get. Also notice this is starting to get wider here, and that's an anomaly, and it's unlikely to hold. It doesn't mean it won't, but it's lower odds of holding. One more time, we come down and we get a third momentum buy. This time is one tick below the C period low. And then we rally again. We come down a fourth time. So keep in mind the fourth time down. This is what I talk about. Every time down, it's like a semi-permeable membrane. It weakens that reference. Does that mean it has to go down? No. But it comes down 1, 2, 3. Finally, the fourth time it goes through. When it goes through on the fourth time, it's another mechanical stop level, which is one tick above halfway back. So if you're watching this market in the morning, you're saying this is a relatively low confidence market. It's kind of what we would expect, opening within the previous day's range. Generally speaking, the odds increase that we're going to get a rotational type of trading day. So now we come to one tick above half back. It is not a reference. I recognize the reference, but it's not a reference I have a great deal of confidence in that it will hold. Finally, the market comes down again in E period, takes out D, we get a little extension to the downside in F period. At this point in time, we are 5 wide up here, we're 5 wide here. I close out the puts because now let's go back to some of the things people said earlier. Value is, we did not get to the base of the spike, so value is building higher today. Value is one of the better filters we can ever have as to what's really going on in the market. Yes, we have this chop in the morning, but we're getting the value down there. We're getting value higher, so the odds are that we're not going to get a lock on the downside. We finally clear out these weak references. Remember, we were 4 times to the momentum buy, 1 time at half back, and then we finally came through half back. We got the stops that were there, and it wasn't a great low because the low was exactly at the opening price, so that's not a very confident low. The reason I closed out my positions in here was simply because it was getting too wide up here, and the chances are we're going to get pulled back up there with value being higher. So that's really how I look at a day. Now, let's take a look, and just for the heck of it, I'm going to walk through what I did that day. What I wanted to do, I wanted to trade some small positions. I wanted to make this as real as possible, and I wanted to see, okay, what can you do in a choppy market like this? So let's go back very quickly and review the market. So the first thing I said, when the market broke, the high was, that's a second high, I think, was just about at the below Friday's high at the top of the spike. Then we had market broke a little bit. We had a market rallied, left us with a poor high, meaning no excess. Then we had a little range extension once it went above the Thursday's high. And we remember we kept coming down to the MOMO or the momentum buying references. I didn't think those references were going to hold. At that point in time, I decided, well, I'll try a little put position and see what goes on. The market comes back there. You remember it came back a third time, finally a fourth time, half back, and then the market finally went through. When it went through, because it was 5 wide, I closed out the positions. Now let's take a look. And forget about the 7 lot in here. That was a trade. That was a trade that I closed out from a position I came in with overnight. So the first trade I bought calls on the first break. Remember, I didn't think the high was any good. It didn't give me much, but I got $120 out of it. I bought puts, I believe, twice down there, and I got $300 out of that. And I bought puts one more time for a 2 lot, and I got a little bit out of that. You saw where I closed out all of the positions because the market got to, it was 5 above, value was higher. I didn't think I had much chance for anything meaningful on the downside. So there was a lot of chop in there, and all I did was copy this right off of my account. It's not something that's made up. It's just strictly copied off the account. Not a lot of money, but there wasn't a lot going on in the market. What I wanted to do that morning, and I didn't know what the outcome wanted to be, I wanted to walk through how as a short-term trader, you look at the market, what are the things you are considering, what trades might you do, so that, and you have some reason for doing those trades. Okay, Julia, what I want to do now, I want to open it up for some questions, and then after we do some questions, we'll go to my screen, we'll look at today, and then we will close by talking about expectations for tomorrow, or at least what to look for tomorrow. Questions, please.
Yes, we did have a question earlier that if you could go over today's market, you know, it was a little wild, and so definitely would like to cover that.
Yes.
The software that Jim is using is Window Trader Blue. So it's window without a W, WINDOTRADER, windowtrader.com.
And this is Terry Lieberman. Terry and I were partners at one time. So a lot of what you see built into Window Traders Window Trader software is a lot of things that I wanted as a trader. I wanted to be able to see the volume for the current period, total for the day. I wanted to always be able to know where the opening was. I wanted to know where half back was. Let me go to example here for a second. Whoops. Okay, and you'll see there's half back from overnight. If you look at the white line, that's half back for where the market was at this point in time. There's the opening. Those are just little references that I always want to be aware of. The reason those references are important to me, it tells me who is trading. When the market goes exactly to references, nice, neat references, half back, the opening, etc., I am looking more than likely at short-term traders. The behavioral characteristics and the expectations of what I think I'm going to see from the people I'm competing against are quite different than if I have longer term or more serious money in the market. It's more serious money, they don't care about those references. They will just cut right through them. So that is a way to help me understand who am I competing against. Additional questions, please.
Yes, thanks. Jim, you trade options. You know, someone's asking about your options trading. If I may just interject, in the upcoming program, just like we've done in past 5-week online session programs, Jim has options sessions to share with traders how he trades options, but it's not a focus of the program. Many people in the program don't necessarily want to learn about options, so those are sessions we have for those that are interested. So it's not a focus of the program, but we certainly go over it, and the past webinars from other online programs, you know, the option webinars are there for you to review as well. Did you want to add anything to that, Jim?
I am strictly an option buyer. I never sell premium. I mean, I might sell premium against an option I was long, but I never sell naked premium. And I think it's the worst strategy available. I will buy and sell the options outright, or I may trade futures against the options. But it's different than what most people do. Additional questions, please. So basically you go long when it came back into the overnight range. Is that the logic? No. I didn't wait for it to come back into the overnight range. When the market was breaking and I saw the high, and it was so exacting. As the market was breaking and the tempo seemed to be fairly slow, I just step up and buy it. I'm not waiting. A lot of times people think, well, where exactly did you get in? Where exactly did you get out? And a lot of times that's not the way my mind works. As I've said a lot of times, exactness kills. The most pertinent thing to my thinking on Monday morning was the high. Well, first of all, the long time, at this point in time, I believe the rally high, the current long-time rally high, was made in the overnight market. I know that that's low odds of holding. The early morning high was one tick above unchanged. I know that's mechanical. I know the odds are pretty good that we'll come back up through that. So as the market was breaking and I thought the tempo was slow, I just stepped up and bought the calls.
Okay. Jim, quick question here. Why buy puts with the higher value starting, instead of looking to buy calls?
Okay. Remember what I said. I was trying here to do trades for short-term traders. I don't do that many trades a day. And what I was trying to do here is, a lot of people trade a lot more than I do. I was trying to demonstrate trades that you might make. And at that point in time, I'm simply watching the flow of the market. And it was slow going down, and then when it rallied, I thought the rally was slow. And then when it came back, and after, I don't remember exactly when I did it, but then when I came back, remember I showed you it came back 3 times to the exact level where the momentum buyers would be. And at that point in time, I'm saying, I think inventory is long, and I think it's probably relatively weak because they're buying at an exact level. And at that point in time, I elected to buy puts. And I think I did that a couple of times in there. And remember, it went down 3 times, and then finally it broke to half back. Then finally it broke again below half back. And when it broke again below half back is when I closed out the puts. That's also when I closed out the example that we're using for today. That does not reflect on what I did later in the day on the market. I'm only showing you short-term trades that I thought could have been done for those that a lot of peak traders trade far more than I do. I have always been critical that a lot of traders overtrade, and it's too emotional. And what I'm trying to say, what I was trying to show the examples here, if you are going to be a very active trader, I was trying to show here are the things that you look at. Here's the things you look at. Here's how you identify the potential trades. Notice there is nothing about the exactness of where I get in and where I get out. I don't do that. When I decide that the odds are in my favor, I put the trade on. I think exactness kills. Now, I'm watching the exact references when it went down to the exact high and the momentum traders were there 3 times. I am looking at that. That piece of exactness is telling me that I think every time it goes back up, I think that I've got long inventory, and I think it's relatively weak inventory, and it could be forced to liquidate. So that's what I was simply playing that morning for what short-term traders might want to do. But it's a good question, a very logical question. But I was trying to say, remember, we opened within the previous day's range, opening within the previous day's range. Early on, I have a better opportunity to have a rotational or trading type of day. It's a continuous two-way auction process. We went down, we went up, we went down. Remember, as each continuous auction gives you a different look at the market. As we got that last auction where I closed things out, as we got this last auction where I closed things out, now I'm looking and I'm saying I'm 5 wide up here this late in the morning. the odds of having much more on the downside aren't very good. So at that point in time, I closed out my put positions, and I'm now flat, and that's where I ended the slide for today's presentation. Because remember, this continuous two-way auction, you always gain information from that auction process. And that's, as an experienced trader, that's what you want to try and think about and read those auctions. Is it a lot to do, a lot to ask? It most certainly is. It's a tremendous amount to ask. But remember this, if you go out to learn to play tennis, you can start off and you can hit the ball against the wall, and then you can play in a novice tournament, and then you can play in a beginner tournament, and you can work up the ladder playing people of your caliber as you learn to play tennis. You do not have that opportunity when you trade in the stocks or futures, when you're day trading stocks or futures. The only place you can trade real, and it's the only way you learn, you have to trade and compete against the best traders in the world. Yeah, about 98, probably 98% of, new traders don't make it, or they blow out their account a few times because they have to compete against the best traders in the world from day one. We don't have any beginning ladders. Paper trading doesn't do anything because half of it's market understanding, half of it is emotional understanding, your own emotion. So you're trading against yourself versus others very often. So what I'm trying to do here is I'm trying to say, okay, here's what you have to be able to look at, and here's how you look at a market to help you, without a lot of time, get in and compete against the people in the market that you need to compete with to come out ahead. And at first, it's overwhelming. There's so many things to look at. But by showing you what to look at, you start to pick it up, and it's like backing out of the garage. It slowly becomes second nature to you. And you know how, when I look at a market, immediately I know, is overnight inventory long or short? Am I opening in or out of balance? How much confidence do I have around the opening? Those things, when you first look at it and you're doing one at a time, it takes a lot to make a mosaic on it. The more you practice, the more you get a mosaic, and the more you start to develop an understanding of what is going on in the market. That is providing that you can come into the market without a bias. And that's what I talked about, a new definition of cognitive dissonance. You've got a bias that you just aren't going to accept new information. You've made up your mind. Those are killers in the marketplace. So again, and when we go through the Mastery Series program, this is what we try and do every day. And we can't do this detailed for every day, but most of our early morning webinars are around the opening to get you off to a good start. And then I chat throughout the day. There's a one directional chat page that I keep putting comments on the live chat, in order to help you more and more have some idea what to focus on. And it's difficult at first, and over time you get accumulated experience, and when you get accumulated experience, you get more adept at being able to be and understand what is going on in that market. Additional comments or questions, please.
Bruno, I'll get to your question in a second. Please discuss why you name a, quote, poor high. Of what importance is a poor high rather than a different high? Of what importance is excess? If you could answer that.
You need, whether it be a short-term auction or a long-term auction, you generally need a completion to that auction. So if you don't have any single prints on the top, that's a sign that you probably just, it just faded right there and you got some selling. There wasn't any completion to the auction. So, and it wasn't aggressive. The single prints means a more aggressive sellers came in at that point. When it goes up there and you have a poor high where there's no excess, it's probably just liquidation, meaning old business was selling versus new aggressive money. When it goes a poor high is no excess. A weak high is when it went to an exact reference. Again, when it goes to an exact reference, that's usually an indication that you have mechanical selling or weaker selling rather than stronger selling. Weak highs, poor highs, they are something that, again, as we go through the course, start to become second nature to you. Now, does anything work 100% of the time? Absolutely not. I said in one of the programs we did earlier, when I first learned about I came up with the idea of weak highs and lows a couple of years ago. When I first started was poor highs and poor lows. And when I first learned this many, many years ago, my estimation is that it probably cost me $250,000 before I was all done, because I'd have a poor high or a poor low, and I wouldn't come out of a position because I said, well, I'm coming back there. Well, sometimes it didn't come back there. And then I started to investigate, when doesn't it come back there? Many times a poor high can occur when the market is too long. When the market is too short, it's not uncommon to get poor lows. When you're too short, people are just waiting for some point to cover their shorts. And we're going to talk more about this when we go into today's market. Okay, a couple more questions before I go to take a look at today's market.
Yes. The question is, on many webinars in the past, Jim talked about overnight inventory and that he's only interested in the overnight high, low, and if the inventory is long or short. But today he spoke about the halfback and the overnight, which if you're on the in the programs, the intensives or now the mastery series, he does use the halfback quite a bit too. But if you want to comment on that, Jim.
No, that's absolutely right. Yeah, I generally look and see the high, the low, is inventory long or short. But you're right. When the two things, if I have a double distribution from overnight, I will look at each distribution. And because when this market went up the other day to half back, again, it tells me, it gives me information, and information it gave me who was selling at half back from overnight. It was short-term traders. Because think, if logically, long-term traders or long-term money that's in the market, they have no idea where half back from overnight is, nor do they care. So when I see those references, then that gives me an idea of who I'm competing against today. And it makes a lot of difference. I used to play a lot of handball and then racquetball. It made a lot of difference. You're playing against a left-hander or a right-hander. What kind of shots were they good at being able to get? Where could you get them off balance? You're always competing, and there's no place you compete more than when you are trying to trade in the marketplace. Everybody is trying to take your money. Okay, 2 more questions, and then I'll go to today.
I like the idea of calls and puts versus the actual futures, contract outright trades. Can you comment?
Not really, because I like them. No, I like them. Now, it's more complex. When you use puts and calls, as I do, just simply to buy and sell, it is more complex, and it adds in additional pressures to trade correctly. Because if you're wrong, it can be the thing's worthless almost very, very quickly. So the reason I do it is I don't have to worry so much about some crazy announcement coming out and having the futures just crater on me. With futures, I have to have some stops someplace. And again, I say it, you're using futures, you shouldn't be taken out of your stop more than about 5% of the time. You want to be able to come out of the market, the trade on your own. But I don't really like stops. Now, one of the problems with options, I don't use stops with options. The option itself, my risk is limited to what I paid for the option. I do it because it gives me, it lowers my emotions quite a bit. I have a lot of scars from trading many, many years. I've had a lot of disasters. As I've said to people, I probably lost more money trading than most people have made in the years. There's a lot of scars. So that's why I use options. I find it more comfortable for me. Okay, one more question.
Yes. Once you have determined it's short-term traders that are present, how does that affect your trading from that point forward?
Oh, good, great question. Like today in the market, we had long-term or serious money all the way in the market today. Okay? I wasn't talking about any short-term traders in the market. I was talking about serious money traders. The market's going higher, and it was, when we go that, you'll see it from the opening bell. So I'm not going to look and try and fade that market. The worst thing you can do is fade a trend. My standard thing is that the worst thing you can do is fade a trend day. The other part of that comment is, if you insist on fading a trend day, you want to fade it very late. I'm not saying you want to fade it late, but I said if you're going to fade it, you want to fade it late. Anybody that's been around me knows that's a standard comment you hear from me. One of the worst mistakes traders ever make is fading a trend day. If, in fact, you insist on fading it, you want to fade it late. Now, when you have short-term traders and you have a rotational market, now you're looking for shorter-term trades. You're looking for shorter-term trades. You're not looking for the home run. You want to take a hit. Get your profit, get out. Get your profit, get out. Just like I did. I showed you those trades down. They showed 3 trades. I think there was actually 4. I think I did the puts twice. So again, I'm taking short-term trades because that's the trading atmosphere that I saw us in on Monday morning. I adapt to the market. I don't expect the market to adapt to me. So what kind of how much confidence? Is it a rotational day or a trend day? Has a lot to do with how I trade and a lot to do with what expectations I'm looking for. So many times fear and greed get in the way, and we get in a trade, say it's a rotational day and it's going for our favor. Boy, if I got out here, I'd really feel stupid if it went straight up, and we don't get up, and then it goes back down, and then we condemn ourselves, and then we get out at the worst price. I'm saying I'm in a rotational market. I just take the trade, and then I just walk away from the trade. Julia's traded with me, and she knows that I have a great ability, once a trade's over, to be done with it. You need to build. I don't know if you can build that or not. It's hard because sometimes oh my golly, I should have stayed there. You make the decision and you're out. You go on to the next one. Okay, let me go to. Let me get out of here, and let me go to today's market. Okay, we have rules for trend days. We have rules for gaps. The rule for a gap is the larger, and we've said this time and time again, the larger the gap, the greater the odds that the market is going to continue in the direction of the gap. The reason for that is that the larger the gap, the more dislocation it has caused from people that were short, have to meet margin calls, or they have some trading system and it kicks into a buy position, something. The larger the gap, the lower the odds that you're going to get a reversal of that gap early in the day. So that's one. Today's market opened. The low for the day was on the opening, and the market then one time framed higher for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 periods. Okay, it takes 2 ticks below the previous area to stop the one time framing. On a trend day, you usually will stop one time at least for inventory to come into balance. So today, the market, there's high confidence. Remember when I was talking about the earlier day, Monday, it was a low confidence today. Today was a high confidence day right from the very beginning. The market just marched higher. One time framing. One time framing, for those that are new to us, means that the B period low did not take out the A period low. This is an inside bar. Okay, one of the trades we talk about. Go with a breakout from an inside bar. So if you hadn't, people say, well, where do I get on, Jim, if I missed it in the morning? Inside bar. Go long coming out of the inside bar. Balance and excess, the 2 most important things we will ever talk about. So you balanced what the market's doing on a trend day, it's looking for a place where two-sided trade can take place. It finally found that F, G, H, I, and J. Okay, now let's talk about today and see if you see anything similar to what I talked about before. Remember, it was a momentum place where momentum buyers came in. This, I saw the same thing today. There's the G period low. H period goes one tick below it. I period goes exactly to H. So the buyers are only coming in at that exact level. G period, defining G period is an inside bar. H does not stop one time framing. One tick below G. I is one tick, or exactly at the H period low. I think that that is a very questionable low. If early on we had some pretty strong buy, but now people will only buy if they can get this much of an exact buy. So at this point in time, I have marked this as a very questionable low, and I'm saying we'll probably go higher from here, but more than likely it's going to be weaker money. The market then did make this run in J period. And again, one of the things I say, markets are very visual. Markets go to levels that they can see. 2,400. I've marked the red line as 2,400. The market looked above it, and it failed. At that point in time, now you'll say, Jim, but you have a poor high. Yes, I have a poor high. There's no excess. There's no completion to that market. Okay? Everything we do has to be filtered within context. So the market is very stretched out today, almost too stretched out. There's an anomaly here, an anomaly here. This is an anomaly. Anomalies are just areas that kind of stick out like a sore thumb. Let me say a couple things about anomalies. Anomalies usually occur when the market in the buying is very emotional. Another thing I will say about anomalies is that inexperienced traders or traders that are too emotional by nature have a tendency to paper over anomalies. One of the worst things you can do is paper over the anomalies. That's important to look at when you're looking at a market. So this market goes up, you say we got a poor high. Well, remember I said one of the things that can happen when markets get too long, you can get a poor high because the longs get very nervous. But also remember, it went to a very logical place, 2,400. It hit the 2,400. That was it. M period tried to rally, couldn't get back to the 2,400 level. And what did you get late in the day? You got liquidation. You got liquidation. Again, you got the wild emotion. There was a very large gap this morning. Remember, the larger the gap, the greater the odds that the market will not come back and revisit, or the market will continue higher because of the distortion and dislocation it puts in. Early on, I thought, well, we did this, maybe we'll settle back and start one time framing lower. We didn't. C was an inside period. They came and they bought them again. D, E, and it's not uncommon to get one of the later rallies to be a really big spike. You got the spike, then it moved sideways for a couple hours, and they made one more run at 2,400. So that's how I saw it today. Early on today was high confidence right from the opening. Fit the gap rules that we use perfectly. As the day went on, the market, you know, we had this fierce buying early on, and then we moved sideways for 3 hours? 1, 2, 3, 3 hours, I guess it is. And remember, a market needs to go to a level where it can find two-sided trade. In any business, that's the case. Unless two-sided trade takes place, you don't have a real reliable business. So now, what am I looking at for tomorrow as we end, you know, we're coming into the end of the hour? The pullback low from this afternoon is a very important reference for tomorrow. If there is a change relative to today, we will begin to find acceptance below the late afternoon pullback from today. failure to find that acceptance tells us we don't have any change relative to late Tuesday, I guess it's late Tuesday afternoon. Oh, this is Wednesday, isn't it? Late Wednesday afternoon, no change. Trading is about change. So now what I like to do is I like to always have at least 3 scenarios. Scenario 1 would be that I open, within this late range, find acceptance up there, and then, chop around a little bit, finally decide if I want to go higher or lower. That would be a very logical scenario for tomorrow. Scenario 2, I continue down, gap down below today's close. Now, that's not the way I usually look at a gap, but if I open down below today's pullback low at 23.9250 and I find acceptance down here, then my destination trade becomes the top of the gap at 23.8125. And so that's scenario 1, I open in here. Scenario 2, I open down below the pullback low and I continue lower with a high confidence day. That's scenario 2. Scenario 3, I open down below the pullback low today, get a little back to the downside, and then I rally back into the afternoon's range. Those are my 3 scenarios for tomorrow.
And the afternoon range, Jim, you said in this range here, you're referring to that distribution in the composite profile there on the left. The single prints.
I'm talking about the pullback low in end period at 23.9250. So I'm using 23.9250 as my afternoon pullback low to the high at 20.9401. That's my afternoon range.
Which is basically the distribution, though, or you don't want them to think of that way.
Well, it includes this distribution up here where it moves sideways for 3 hours is included, but we look both above and below that distribution.
Well, I was referring to the single prints, the bottom of the distribution. I wasn't looking at the fat part. I was using the single prints and then the double prints and then the pullback makes the triple prints.
Okay. Okay, yeah, I can see what you're talking about when it rallied in F period. But I'm using the range from 23.9250 to the high at 24.10 or 24.01. And I'm saying if I open within this range, I don't really have any change relative to this afternoon. All the market is doing is just digesting that. If I open below it, then I have change relative to this afternoon because I'm continuing to break lower. So I'm getting lower value relative to today, and my destination trade, the first one, becomes the top of the gap. If I open below this, fail, and then rally back up here, then it would target the all-time high. There is no real excess at this high. That can happen. That happens because if a market just got too long. Remember, I put that caveat in there earlier. I've seen it happen. It also, what the market was doing mechanically, trading the 2400 level. Very nice, neat mechanical level. Markets do that. Okay, couple questions and then we'll say thank you.
Okay, 2 quick questions. Larry, I'll get to yours for the end. Arturo, was the C low a Momo buy on the pullback?
I don't think so. I mean, it might have been because it was the A period high. Yeah, it could have been because it was the A period high. But I don't think so. I didn't see it as a Momo buy at that level. I just saw that the market was going higher. The buyers were there, and that's where we were going.
Okay, and quick question here. She had asked, why do you think it was emotional buying in today's market? Institutional emotional buying. So she's thinking it's institutional money, and why would you think it's emotional? Because they're buying above value, or
There's an anomaly right here. Anomalies right here. There was no give and take. The market was just gone. Remember, you opened this high. You opened this much higher, and my guess is it was probably more trading money. Probably more trading money. I mean, long-term, there's long-term trading money, billions of dollars out there. It was trading this market. you know, rather than, it was probably a combination of everybody going higher. Everybody gets overly excited. Remember, all markets are up. All markets are up. All trends are up in here. And that's just where, that's where the market's going. And markets go until it's over. And it hasn't been over for some time. Now, I want to do one more thing. Unless there's one more question here, then I want to go back. I want to talk about yesterday a little bit. Anything else pertaining to tomorrow?
Well, a quick question. Can you repeat the bit about the support or failure at the base of the spike when you were doing Monday's trade?
It's just something we've observed. It's, again,
you want to collapse that, or?
Yeah, okay. What happened here? This was the early morning high at D period.
That's
what
Friday.
Happened here?
Okay, I'm sorry. Go ahead. Okay.
That's right, because we were talking this and we were looking at Monday.
Sorry.
What happened right here? When the market looked above the early morning high, you had change occur, right? That's what the spike is. You had change occur late in the day. Okay, so now the question once again becomes, if you stay above this breakout high, then what you have in there is you have change, and that change being accepted. So this is a support level. If we don't go back there, then there's no change relative to late Friday afternoon. So it didn't go back there. There was no change relative to late Friday afternoon. This becomes a support level because it's the moment of change. Change is what trading is all about. Remember also, we talked about this very prominent point of control. Now I want to go in. I'm going to take yesterday.
Maybe mark that too, the line, the prominent point of, yeah.
Okay. Now, again, here's some other things you have to look at. The all-time high in the day time frame session is made right there. There is no excess on the all-time high. Yesterday morning, we came up and there was no excess on yesterday morning, meaning there's no single prints. So I have two back-to-back poor highs. We've talked about that numerous times. When you see that happen, if you call one poor high, let's say it was minus or plus 5, okay? If you had two poor highs back-to-back, it wouldn't be plus 10. You wouldn't add 5 and 5. It's some component of that. So maybe it's plus 5 and plus 25 because of the second poor high. The poor high says there's no completion to that market. Now remember, it happens sometimes, but two of them lowers the odds. Now, the market yesterday was selling off, and I'm going to collapse this again. We did get down to that point of control from Friday that was revisited. We did stop one time framing higher on a daily basis. Now we're going to look at something else. When Friday was coming down, notice 1, 2, 4, 6, 8, 9 wide, 9 wide. And when this market is breaking, this is how trading is about thinking in terms of odds. I have a poor high, I have another poor high, so I have two back-to-back poor highs. This market is breaking, and it got to Friday's point of control, prominent point of control, but there's no elongation on the downside. It's 2, 4, 6, 8, 9 wide here, 9 wide here, and this is the traditional line that we talk about, the 45-degree line. Now, people that are new to us won't know what that means. 45-degree, and I'm just taking from the low up to here, and I say when the market's breaking, the point of control is the fairest price at which business is being conducted. So the fairest price at which business is being conducted is not it was here, which this is another feature of a window trader. It was here early on, then it moved to here, then it did finally move down to here, but it really wasn't doing a good job of elongating to the downside, of really moving the point of control lower like it does on a trend day. So late yesterday, I went home long the 2370 calls last night because I bought them on this late break yesterday because this market just wasn't doing a good job of going lower. I had two back-to-back poor highs, so I thought there was a pretty good chance that I would get a rally out of this market. And I did get a rally out of this market. Again, that's how, you're always looking and saying, how do you put the odds in your favor? One, you can be scared to death because the market went down all day and price was lower and value was overlapping to lower. But then I'm looking and saying, but I have a poor high, I have two poor highs back to back. Anybody that's been with us for any period of time knows we talk about that constantly. So when I'm talking about the odds of the market, having downward continuation, the odds are very low because of these 2 points, and it's very low because as the market was going lower yesterday, they sold it off several times. They left an excess low, single prints, much better low than you had a high, and they couldn't really see that point of control, the fairest price at which business is being conducted, migrate lower. Did it get down to here just a tick or two below half back? Yes. Didn't hold there very long as we closed up above it. So when I'm looking at those, I'm saying the odds of the current rally being over appeared to me to be very low. Remember, all trends are up. I prefer to trade with the trend. So all trends are up. And again, yesterday was a very important day to kind of set the stage. The market had all opportunities to sell off from almost the all-time highs, and the market couldn't do it. There was no real selling in that market yesterday. When you talk about how to look at a market, that's part of it. Now, if you're just sitting there, here's other traders talk to me, and they say, oh, Jim, this market's so high. God, I couldn't buy it here. It's just too high. And boy, when it sells off, they think this is the big trade, and they're just too anxious to sell it. Well, there was a lot of trading people selling it, but they weren't joined by stronger money because the market left the poor high and you just couldn't really get any elongation on the downside. So you're saying you're getting some liquidation, you're probably getting a lot of inventory short once again in the market, and that's a very dangerous situation. Now, is it 100%? Absolutely not. But this is the kind of thinking that is so important for you to develop. Trying to develop this kind of thinking on your own is very difficult. One of the reasons that we have the Mastery Series coming up is that it's an opportunity to have someone walk you through what somebody that's been in around the markets for some period of time sees in the marketplace. Now, we don't call trades. We don't call trades when we do the Mastery Series. Our goal is not to give you exact trades. Our goal is to help you learn to think about how to think about a market. And yeah, we'll give you some clues, which, for example, we said one earlier. When a standard trade balance, we always say that excess and balance, two of the most important concepts you can deal with, whether it be long-term or short-term. And we saw today an inside bar in the second or third period go with the move coming out of an inside bar. So we see there are some things there that we've noticed that are fairly common over a period of time. But what we're trying to do is give you some idea how to think about the market, because each one of us has totally different time frames. No two of us are made up the same way. I wouldn't expect anybody to trade like I do, and I wouldn't expect to trade like anybody else. And each has a longer time frame, a different attitude towards risk and reward. But the most important thing is learning how to think about the market. And that's what the Mastery Series is about. How often are you going to get somebody that's going to take you through and give you some ideas of what to look for and how to view a market? Most people won't share this information. So we've got the first course starts May 1st, goes to June 2nd. I keep the chat and doing the daily reports open between these two in sessions. And then the second mastery course comes up July 10th to August 11th. So it's another month in there. And so we start about a week or so before the 1st of May, start, giving you the reports and getting you prepped for the first session. And then we keep everything functioning through the two sessions. In the center of them, still get the daily reports. You get 2 daily reports, and I will continue to make chat comments on the live chat that you get on your machine. But again, it's the idea to show you what to look at, give you some idea to know how to think about being a trader, no matter what your time frame is. Most of our audience are shorter term traders, day traders to a few days at a time, but it's applicable to any time frame. As you know, we always start, you may not know this, I always start by looking at the monthly bars, the weekly bars, the daily bars, and the profile. We always start with a top-down approach, and then we try and fit the scenarios. We'll put up 3 scenarios every day for those that are looking for shorter term trades. Anyhow, I hope you'll join us. Let me say thank you very much for today, and we'll be back next week with the second leg of how to observe a market, and we'll be looking at things a little bit different, a little different time frame, a little different part of the day next week. Julia and all of you that joined us tonight, thank you very, very much for being with us.
Okay, great. Thank you, Jim, and thank you, everyone. This webinar will be posted a little later today, and if we didn't get your question answered, we're sorry about that. Just so many coming at us, but you're welcome to email us or call us, and that goes for any questions on the upcoming program as well. Okay, so thank you, everyone, for being here. God be with you, and have a wonderful evening wherever you're at. Okay, thanks. So long.